After the bear attack in 2022, we've been on a bit of a bull run, which we've been enjoying. Is it going to continue? What are the factors involved? And moreover, what stocks am I trading? Hang on. I am Dr. Stephen Fox. These are my personally selected stocks. This is not financial advice, as I do not know your personal situation. Hey everyone, welcome to my channel. It's hard to believe that we're in a recession when we keep getting pretty good jobs numbers.
All right, John, let's take a look at what we get here, and we do it again. You're the winner, John Farrow. For the 13th month in a row, jobs come in above what was forecast in the Bloomberg survey, 253,000. The survey, as you mentioned, 185,000. Even more significant, check this out, 3.4% unemployment. Wow. The unemployment rate drops by another tenth to 3.4%, was expected to go to 3.6. We have a revision of 149,000 jobs subtracted from February and March. So take that out of the 253 in terms of total number of jobs, and it does show a little more weakness in the job market than we had seen, but on a month-over-month initial report basis, very strong today. Manufacturing jobs up 11,000. Remember, ADP had said we'd lost 38,000, so manufacturing not in as bad a shape as anticipated. Average hourly earnings, Lisa, this is for you. We're up 0.5% on the month, which was much stronger than the 0.3 we saw last month and the 0.3 expected, and that pushes the number up from 4.2 on a year-over-year basis to 4.4%. Average weekly hours, 34.4, unchanged, and the labor force participation rate unchanged at 62.6. So I'll let you check the markets, and I'm sure we have some sort of reaction to that, John, while I dig into where the jobs were created.
Can you just jump in on the slowing jobs growth, whether the trend is there for us to get our hands around now?
There doesn't appear to be a trend in there, although what we seem to be doing is flattening out, because we're looking at kind of the same numbers over the last couple of months. We had 253, and we had basically 236 last month. Now that's revised down to 165, but 248 in February. So we're looking at kind of a flat number, but it's still the same number of a healthy gain. Even 146, you go back to the March number, the revised March number, that would be stronger than we need to absorb all the workers coming into the labor force. Taking a look at the unemployment report, too, we see another big month for jobs. The number of people employed grew by 139,000, while the number unemployed fell by 182,000. The labor force fell by 43,000, so a lot of that was people dropping out of the labor force, but still we're seeing in both the establishment and the household survey a big gain in employment and unemployment falling. It's still a very strong labor market, although to give Lisa her due here, we are seeing a drop in the average, basically, for all of the categories that have added a lot. Leisure and hospitality was up 31,000, but they had been rising at a rate of about 71,000 for the 73,000 for the past month over the prior 6 months. So we're seeing a drop in the additions, but we're seeing a broader group of employment categories add jobs.
Trueflation.com, which uses more sources of inflation data and is much more current, has inflation at below 4%. And also, gas prices have dropped recently, which you would think that would carry forward into lower inflation rates. So I don't see recession on the immediate horizon for sure.
What we're seeing in the banking sector is the market is sussing out those companies that perhaps took on a little too much risk due to a lack of regulatory oversight. They're challenging their business models, and I think that's going to continue with the regional and smaller banks. But when we zoom out a little bit from those banks, looking at the globally systemically important banks, they're actually well regulated, they're liquid, they've shown through their earnings that deposits have stabilized, and they're growing their net interest income. So that gives me some comfort around the banking sector as a whole.
You're not at the moment expecting a US recession in 2023, or that's not the way you're positioning at the moment. And I think that's unconsensus this week. The whole market's coalesced around the idea a recession is coming, apart from maybe Jerome Powell's a little bit more optimistic. I'm curious to get your take. Why no recession? What's the thinking behind that?
Thanks, Mark. Well, the Fed has paused. That's already a very good sign. But also, looking at inflation, I think that's actually going to come down quite notably in the second half of this year. If we look at goods, the supply chain pressures that we saw previously have largely dissipated. That's going to bring down the price of goods even further. And looking at the services sector, for example, and wages, we've already seen signs from the JOLTS data earlier this week that the job market is cooling, and so we should see some relief from that wage pressure as well. I'll also mention here that the consumer is extremely resilient. So I certainly think that we can avoid a recession for 2023, and I'm in agreement with Jerome Powell on that point.
And I think the Federal Reserve has things set up with their bank term funding program and their discount window to help struggling banks. Some banks will fail. There probably will be a few more that are failing. But some of the banks, like PacWest, whose symbol is PACW, that stock had a major recovery on Friday. And some people are saying, well, maybe these regional banks are something to buy at the bottom, which I almost never like to do, and I'm not going to do it now, or to buy the regional banking sector ETF, which is KRE. But I don't think that's wise. I think a better strategy is to buy JP Morgan Chase, whose symbol is JPM. And they're being given these banks, and they're making lots of money on these other bank failures. So it seems like a sound investment.
Mark, let's talk about the markets in 3 minutes and start with the banking sector. As I said earlier, just like yesterday, we see overall sentiment not necessarily hugely derailed by this. That's not true all the time, but at this stage of yesterday, that was also the case. We saw a really specific issue in regional banking in the US, and yet futures were higher. Today, futures also higher. Now, we're waiting for the jobs report, of course, but do you get any sense that we're trying to throw a sort of a ring around this, draw a line in the sand around the regional banking story? It just keeps to go on and on.
Yeah, the regional banking story is going to go on and on for a while. As kind of Valerie outlines, guaranteed deposits may not even end it now. It may ease it, but not end it. And remember, it is weekends where we see banks get bailed out because it's much easier time to kind of manage that process. So I expect there to be pressure on the regional banks again this Friday. But it's really important. This is nowhere near a systemic crisis. This is nothing like 2008, 2009. The US has, I think, still more than 4,000 banks, which is a few thousand too many, arguably. And, despite the fact that it's got these thousands and thousands of banks, we now know that JP Morgan is way too large a share of that banking. Sorry, I shouldn't use the phrase too large. It is a very large share, despite the fact there are thousands of banks. The systemically important banks have different capital rules, different regulations, and they are not under threats. This is not a systemic crisis at all. However, it will have a proper growth impact. Now, the problem is that growth impact will come with a lag. People who are trading the credit contraction to come from the regional banking crisis might be trading it too soon. It is a very, very valid theme, but it might not be something we see for many months yet.
A major happening was on Thursday when Apple reported good earnings. The stock immediately shot up to 173. Looking at the chart, it has a relative strength of about 68, which is good. And right before it went up on Thursday, it bounced off its 50-day moving average. So this looks like a potential breakout. It probably will go to about 180. if it hits 180, it'll be a $3 trillion company. It's a $2.75 trillion company right now, market capitalization. Of course, we have to talk about my favorite stock, Super Microcomputer, SMCI. I bought it in the aftermarket on Thursday for $114, and by Friday it had gone up to $137. So I'm well pleased with this. I've been pounding the table for over a year on this, and it's good to see it come in, although it's been going up regularly throughout the year. It's a somewhat small company, SMCI. It's about a $7 billion market capitalization. As we look at the chart, you can see that it broke out above its Bollinger Bands, which indicates a breakout, is my thought. And its relative strength is 72, which is very good. So I think we got a stock that's been breaking out and it's been waiting to break out. And I think Apple helped provide some of the impetus because, like Apple, it is a computer maker. It's a computer equipment maker. So they have that in common. And I did buy some JPM, some JP Morgan Chase, on the thesis that they acquire these banks and they make all kinds of money out of the different bank failures. So I think it's a conservative thing to do. It pays almost a 3% dividend, and I don't own enough dividend stocks, so I probably should, quotes, do it. I think it's not a stock to worry about. That's where I do my banking also, so I feel some loyalty to it. And then I bought some building stocks, okay? I just bought one, Sky, SKY, which builds Champion Mobile Homes. And that it makes sense to me that when houses are as expensive as they are, that they sell more mobile homes. It makes sense to me. But other not mobile home, but building products companies in general are doing well. The problem is that they're all overpriced. This Sky, SKY, was a relatively cheap stock. It's not overvalued at all. As we look at the chart, Skyline Champion Corporation, SKY, Sky, its trailing price to earnings is about 10. Its forward price to earnings is about 17. Okay, but it has a decent earnings growth rate of 18. Again, this is one that the thesis makes sense to me, that people are probably buying more mobile homes now because the prices of homes are more expensive. So I'm willing to give it a shot. And just generally because building material stocks have done well. And I think it's because the cost of materials have gone down, especially lumber. Lumber was like above 800 and now it's below 400. So there's really been quite a difference in their expenses for these stocks. And looking at a more detailed chart on Sky, we can see that it has a nice movement upward over the last year, especially more recently. And its relative strength is 52, indicating that it's neither overbought nor oversold. And it is above the 20-day average. That orange line in the middle is a 20-day average for the stock, and it is above that. So it's a stock that makes sense to me, much like JP Morgan makes sense to me given the circumstances. Be sure to smash the like button if any of this has been helpful. And I think we have a little bit of a bull run here for a short while. Whether it's going to last or not is the question. I bought very conservative stocks that I wouldn't be too worried if things did go south. So I'm mainly planning to hold on to these unless something horrific happened. And I don't expect horrific things to happen. With the oil price going down, jobs are holding up. And it looks like Ukraine could possibly put an end to this war, which would be such a blessing, which would reduce inflation and take all kinds of economic pressure off the United States and Europe. So it would definitely be a very bullish thing to happen. Thank you for watching.